Welcome to this month's market update. I'm Damon Grewal, joined by Shahana Mukherjee. How are you, Shahana?
I'm doing well, Damon. Thanks. How are you?
Doing well, and plenty happening in markets, geopolitics-wise, elections-wise, and some really important data coming out as well. I was just curious if you could tell us a little bit more about some of the US and Australian inflation print that we've seen come out.
Certainly, Damon. So there continues to be a lot of focus on inflation data coming out of all markets, also the case for the US and Australian economies. Now, just thinking about US inflation now, that data has surprised markets on the upside, particularly in the last couple of months. And thinking just about consumer inflation as measured by the CPI or the Consumer Price Index, the data for March showed that inflation rose to 3.6% over the year, which followed a smaller increase of 3.2% observed in February. And just to provide some context, now this marked the highest annual inflation rate observed since September last year. So it is quite a noticeable trend, if I were to say. Just thinking about the main drivers of this increase, now shelter continued to be quite a significant contributor, but we also saw energy contribute to this increase. In fact, the index for gasoline and shelter cumulatively accounted for more than half the monthly increase in average consumer prices. Now, we have seen core inflation in the US settle at, or rather be steady for around the third straight month. But it also does signal some of that underlying momentum that we have been seeing in the US economy for quite a few months now. Now, comparing that with the Australian data, Australia's inflation for the March quarter eased to 3.6% over the year, down from 4.1% seen in the December quarter. Now, while there was a slowdown in the annual rate at the headline level, this definitely did come in above market forecast. So once again, that's a surprise. And the quarterly increase at 1% was actually higher than the previous quarter's change of the quarter at 0.6%. Just thinking about underlying inflation in Australia, which is represented by trimmed mean inflation, that eased down to 4%. That's actually down from a peak rate of 6.8%. But having said that, we continue to see that being outside the Reserve Bank of Australia's preferred 2% to 3% target range. In terms of what has driven the headline rate in Australia, shelter or rent inflation continues to play quite a strong role. But we also saw, education expenses, but also healthcare expenses contribute quite meaningfully this quarter.
Yeah, a few items there like education and health that seem a little bit stickier than others, and I think plenty of lament about insurance costs going up as well, which has been somewhat painful. So just curious, how has this impacted the decision-making of Jerome Powell and Michelle Bullock? Well, I should say the committee, not Michelle Bullock.
That's fine. Look, the central banks actually consider a host of economic data in addition to inflation in deciding just how appropriate the current policy settings are. Yes, we have seen inflation data come in, stronger than market forecasts, but this has also been seen alongside labor market data, which has come in fairly strong as well. There were some signs of rebalancing taking place, particularly in the US labor market. If you just think about the data released this week, we did see that the number of new claims for unemployment benefits actually rose to an 8-month high in the US. And at the same time, we saw fewer job openings and also fewer new jobs being added to the market. Now, it is possible that the Fed will likely want to see steady progress in this front towards more normalizing, less tighter labor market conditions to gain more confidence in effectively and eventually moving towards less restrictive monetary settings. But for the time being, we've seen both the Federal Reserve as well as the Reserve Bank of Australia leave their policy rates unchanged. So the Federal Reserve actually maintained its Fed funds rate at its target range of 5.25% to 5.5% in its most recently concluded meeting. It also decided to slow the pace of decline in its Treasury and debt securities holdings. So effective June, we will see the redemption cap actually being reduced from $60 billion to $25 billion. With the Reserve Bank of Australia, the cash rate was left unchanged at 4.35%, but the central bank also noted some of the short-term risks to inflation. We have seen petrol prices contribute a fair bit recently, and that's a pressure point, definitely. But just overall assessing the risks to inflation, the central bank did decide to upgrade or upwardly revise its inflation projections in the short term. So the current projections actually indicate that inflation, the headline rate is expected to settle at 3.8% by the end of this year, as opposed to 3.2% expected previously. And inflation is forecast to return to its target range of 2 to 3% in the second half of next year.
Well, a lot to take in, a little bit more pain ahead for borrowers perhaps as they look at these plots coming out of these central banks. I'm just curious, how are markets taking this on board in terms of forward rate expectations?
Certainly. So market expectations have been very responsive to a lot of this data coming out of the US and Australia as well. So just thinking about what this means in terms of expectations for the Fed funds rate. Now, markets were pricing in fairly meaningful rate cuts, particularly after the start of this year. But that expectation has moderated a fair bit over the last few months. In fact, the current pricing actually suggests some potential for up to 2 rate cuts, followed by more meaningful rate cuts in 2025. But the Fed funds rate, as for current pricing, does suggest that the Fed funds rate could settle at potentially just under 5% by the close of this year. Comparing that to cash rate expectations, the RBA has been more cautious in its signaling for the potential for rate hikes to start soon. And what that meant is that until March, markets were pricing in fairly modest rate cuts for 2024. Now that has changed. In fact, current pricing does suggest that the expectations for cash rate have shifted up. And the current path seems to suggest one more potential cash rate increase later in the year, followed by cash rate cuts to begin only from 2025.
Yeah, that's very interesting. As we kind of spoke about last time, cash seems back as an asset class, and it seems like cash could be perpetuated as a meaningful contributor as a result. So thank you so much for the update, and thank you so much for joining us for this month's Market Update.